Defaulted student loan collections are a-comin'. The Treasury is actually setting to ramp it up in July. That is our topic for today on the College Investor Audio Show. Hello and welcome. If you want to dive deeper into this topic and all things we talk about on the podcast, you can always find the article associated with each audio show at thecollegeinvestor.com. You can also follow, and all the things on social media. We're pretty much anywhere you are. Just find us at The College Investor. We'd love to connect with you. All right, let's check this out now. Hundreds of thousands of federal student loan borrowers in default could start hearing from the government and their debt collectors as soon as July, as the Treasury Department prepares to take over a piece of the Education Department's collection work. That's what Politico has reported, and here's why it matters. This would be the first major step in moving the $1.7 trillion in federal student loan portfolio out of the Education Department, and the first sustained collection contact most defaulted borrowers have received since COVID-era payment pause began in March of 2020, over 6 years ago. Collections have been delayed various times since that pause ended in 2023. Here are the details. All right, so the Treasury Department and the Education Department plan to launch Phase 1 of the partnership in July, starting with roughly 500,000 borrowers, according to people familiar with this plan. According to the Politico reporting, a Treasury spokesperson disputed the figure but declined to provide an alternative number. Affected borrowers should expect phone calls, letters, all that stuff about missed payments. More aggressive tactics, including wage garnishment and benefit offsets, are not expected to begin until sometime after the midterm elections. One of the people told Politico this information. Both agencies said there is some information in the report that was incorrect or even false, but did not specify which parts. And the general trend of collections resuming does make sense in the bigger picture. And here is the bigger picture, by the way. The Trump administration announced in March that the federal student loan portfolio would gradually shift to Treasury through an interagency agreement. Phase 1 of the plan involves student loan collections. Education Secretary Linda McMahon said at the time that Treasury was better equipped to handle the work, citing its world-renowned expertise in finance and economic policy, and noting that nearly a quarter of student loan borrowers are in default. Wow. Here's how this all connects. Collections activity on federal student loans officially restarted on May 5th of 2025, over a year ago, when the Education Department resumed the Treasury offset program for the first time since 2020. However, the department then paused the offset program right before tax season. More than 5 million borrowers are currently in default. Crazy. And several million more are at risk of joining them as missed payments accumulate. Borrowers worried about being pulled into collections still have options, though. Student loan rehabilitation and even loan consolidation can move a defaulted loan back into good standing and stop wage garnishment or even tax refund offsets before they start. If you're nervous, you can enroll in an income-driven repayment plan, which are cheaper than what collection costs are going to be. So just go do that. We have links and resources about income-driven repayment plans galore at thecollegeinvestor.com. Just type in those words, income-driven repayment plans. You're going to find exactly what you need and what you're looking for. If you have questions, anything else you want us to know or help you with, please drop us a line on social media. Just type in the words, The College Investor. You'll find us. Thanks so much for stopping by today, and we'll talk to you again real soon.